Hello everyone, we are the Group 1 and we will be tackling entrepreneurship in finance. Though it sounds obvious, this basic idea must be emphasized from time to time. You are in business to make money, caught up in the throes of everyday business activities ranging from selling to managing operations. Entrepreneurs often leave matters of finance to fall by the wayside. By the time they realize the importance of closely monitoring their finances, it is already too late. The damage has been done. That's why in this chapter we will talk about the different ways on keeping up with your finances.
You don't need money to make money. You can obtain lots of resources for free, but it might take money to make lots of money quickly. Hiring a professional accountant is money well spent. It is a wise investment because they ultimately save you time and money in general. Manage debt well. The majority of business failures are caused by entrepreneurs who don't raise enough money. Undercapitalization.
Pay tax quarterly. Otherwise, you may own more than you can pay at the end of the year. Estimated tax is a quarterly payment of taxes for the year. Most of those required to pay tax quarterly are small business owners, freelancers, independent contractors. Focus on building revenue. Investors cares about sales and revenue. Revenue is the total amount of income generated by the sale of goods or services related to the company's primary operations. Revenue, also known as gross sales, is often referred to as the top line because it sits at the top of the income statement. The biggest investment is your company is yours. People are more likely to invest when you have invested your own money for at least time into the business.
A check in hand means nothing. Don't assume that you've been paid not until the money is in the bank. Always double check dubious checks. Prepayment is king. Disregard standard payment terms. This builds trust with customers to get them to prepay for products or services. Makes your payment terms clear and set up a timeline for getting paid as early as possible. Prepayments are used by individuals, corporations, and governments to settle accounts before they are due. And also, prepayment can be categorized into two groups: complete prepayments and partial prepayments. A complete prepayment involves payment for the full balance of a liability before its official due date, whereas a partial prepayment involves payment for only a part of a liability's balance. There's a downside having investors. Investors often have a high expectation as to how and when they are repaid, as they now have partial ownership of the business. Investors can hinder the decision-making process as their primary focus may not be business success, but rather their own personal investment. Documenting every possible eventuality with a solicitor can alleviate such issues, but can also become costly to the business in itself. Having investors who are friends or family may put a strain on the relationship should the business take a turn for the worse.
Borrow money for a bank before you need it. You are more likely to get a loan when you don't need it, and you will be prepared should an economic downturn hits. Minsan, it's good to borrow or a loan a money in a bank, kahit hindi mo pa ito kailangan, because if have a emergency, you're prepared and di na agad lalaki ang problema. Avoid negative cash flow. It's possible to have negative cash flow a month. Even your company is profitable overall, keep track of this so you can pay all your bill. For example, let's just say your revenue was $20 in this August and your expenses were $25 during the same month. This means you had a negative cash flow of 5,000 in this August.
Use different banks to minimize risk. If your business and personal accounts are at the same bank, they are linked by your social security number. They may see business debt affecting your personal credit report or be pressured to pay off business debts with personal finances. Some experts suggest you should have 4 bank accounts, 2 for checking and 2 for savings. Now let's get deeper onto this topic. First checking account is for bills. First, set up a checking account to pay your bills, whether it's your own account or a joint bank account. You'll use the money in this account to pay for housing, utilities, insurance, your car loan, and any other bill you have to pay. Experts recommended that you do not get a debit card for this account. This way, you won't be tempted to spend your bills money on other things. When you want to spend money, you can use your second checking account. The second checking account is for other expenses. This checking account is for everything other than your bills. You could use it for entertainment, meals at restaurants, or gifts for friends and families. Go ahead and attach your debit card to this account because the money is primarily for spending. Third is savings account for your emergency fund. An emergency fund is money you only use when unexpected happens. Maybe you lose your job, or your car breaks down, or you receive a huge hospital bill. You only touch this money if there is an emergency, so it's wise to keep it in an account that's separate from the ones you use for bills or other savings goals. And lastly, savings account for other goals. Finally, there's an account for other big savings goals. You might use this account to stash away money to buy a car, make a down payment on a home, pay for your wedding, or set up savings for your child. If you use a bank that makes it easy to save for separate goals, you can even create individual savings bucket for each goal in one account. This makes it easier to track how much money you have set aside for each purchase. That is all for our group. Thank you for listening.